Good morning, and thank you for joining today's webinar, which will provide an extensive Perpetual-Life BDC review, along with an outlook for the remainder of the year. New research, including our BDC reports, can be accessed through the QR code on your screen, or by visiting kbra.com. Here, you'll also find information on our upcoming events and webinars. Should you have a question for our presenters, we encourage you to submit these via the Q&A feature. If you would like to connect with our experts to discuss today's topic in more detail, our business development and investor relations teams would be happy to arrange a follow-up call. Now, I'd like to hand things over to Bain Moore, a Managing Director within KBRA's Financial Institutions Group, for introductions.
Wonderful. Thank you, and thanks everybody for joining. Today we have a great panelists to discuss not only BDCs but then also middle market lending. We have Shane Olaledi, who's a Senior Managing Director in our Corporates Group, Josh Mandelbaum, who's a Director in our Financial Institutions Group, Kevin Kent, who's a Director in our Financial Institutions Group, and Terry Seelig, who's a Managing Director in our Financial Institutions Group, each each either covers BDCs or, in Shane's case, manages the large process of our middle market assessment. So with that, let's actually jump, Shane, to you first to maybe set the stage. So before we specifically talk about BDCs, can you talk a little bit about what we're seeing at the borrower level, or what are the borrower level trends that we should be keeping in mind as we think about private credit performance, defaults, and some of the other headlines that concern artificial intelligence or AI?
Thank you, Bain. Can we go to the next slide, please? So before I get started, let me just briefly introduce myself. As Bain has mentioned, I am Shane Olaledi. I'm a Senior Managing Director here at KBRA, and I lead our corporate credit assessment team. Our team actually just completes the credit assessments on the corporate obligors that sit within KBRA's rated private credit transactions. And that actually gives us a very broad view into borrower level performance across middle markets. And that includes trends in growth, leverage, interest coverage, defaults, and sector level stress. So for my portion, I'm going to use our assessment portfolio to set the backdrop of borrower level performance, and we'll then lead that into the broader private credit and Perpetual-Life BDC discussion. Next slide, please. So it's helpful to start to look at the size and breadth of KBRA's middle market assessment portfolio, because it gives us a very pretty differentiated view into what is happening beneath the surface of private credits. So over the last 12 months that ended March 31, 2026, we've actually completed more than 3,600 credit assessments across more than 2,400 unique global middle market sponsored backed borrowers. These borrowers represent close to $1 trillion of debt, and that portfolio spans a broad range of sectors that generally mirror the direct lending markets. And so one important thing to see from this portfolio is that it's mostly oriented towards service-based business models, and that matters because in our view, many of these businesses have been better positioned to navigate the combination of slower growth, higher rates, repeated macro shocks, and more cyclical or goods-oriented borrowers. So when we talk about credit quality in private credits, we're not just relying on public market metrics or looking at a sample of issuers. We're actually looking at a very broad-based surveillance portfolio across lower, core, and middle market borrowers. Next slide, please. So in this slide, what you see is looking across our borrower portfolio, and we've broken this by borrower size in revenues. One of the interesting things that we actually find is that growth remains relatively consistent across all revenue quartiles. The largest company tends to grow a little bit more slowly, in here 11% compared to 13% on average. And that's not surprising given their large size. But we're not seeing a dramatic divergence in growth or interest coverage based solely on size. In our Q1 compendium, which we published about 5 days ago, I always recommend everyone read it. What we state in there is that median revenue the compounded annual growth rates across the median revenue of our portfolio is at 13%, and the median CAGR is still strong at 27% growth. So that EBITDA growth has actually helped push the median interest coverage to about 1.6 times as measured in that compendium Q1 2026. So the first thing I want to point out from this data is that median borrower, at least the metrics continue to be stable. That doesn't mean there's no stress across the middle markets space. It just means that the broad portfolio is still producing growth, still generating EBITDA, and still showing improvement in coverage. So the better way we like to frame this is that there is stability at the median, but there are some stress concentrated in specific pockets. Next slide, please. So this slide actually adds a little bit of nuance that I have mentioned. A prolonged period of double-digit growth that we have seen in the past has actually allowed a lot of borrowers to maintain their credit quality, but that pace of growth is clearly decelerating. It's important because that growth has been one of the major offsets to higher interest costs and elevated leverage. So if a borrower had strong top-line growth, was able to expand its EBITDA, it basically had a lot of room to absorb a higher debt service burden. But obviously, as the growth starts to slow, the margin for error is narrowing. So what we're seeing is clearly in most sectors where borrowers already have weaker liquidity and elevated leverage or near-time maturities. In our compendium, we noted that consumer and industrial companies are the ones that we are seeing. They've been dealing with a lot of post-pandemic normalization, price-sensitive consumers, limited pricing power, cautious capital spending, and that's where we see a lot of the stress right now within our portfolio. But the key message, again, I want to continue to reiterate is that the growth is not disappeared, but the easy part of that cycle is not behind us. The companies that still have durable demand, pricing power, and good cost controls are generally holding up. The companies that were already stretched are the ones where slower growth is going to become a credit issue soon. Next slide, please. So what this slide is actually showing is the interest coverage. And interest coverage is one of the more constructive part of the story that we tell. More than 60% of the companies within our coverage portfolio increased their interest coverage ratio over the last 12 months. Again, helped by a combination of that EBITDA growth and some rate relief. So median interest coverage ratio actually increased to 1.6 times, up from 1.4 times last year. And that's real improvement. In our view, it supports the underlying credit quality is improvement at the portfolio level. That being said, I don't want to overstate it. About 1/4 of middle market borrowers still have interest coverage ratio below 1. And that just means that those borrowers continue to be dependent on some sort of external liquidity, sponsor support, amendments, or other forms of lender accommodation to continue as a going concern. So the way I want to just summarize this slide is, look, coverage moving in the right direction, but there's still a meaningful tail of borrowers that cannot fully cover cash interest with their current earnings. Those are the names we continue to watch. Next slide. What this slide shows is our KBRA's Middle Market Default Monitor, KMDM. It's our forward-looking gauge of borrowers that are either in active payment default, what we'd consider default, or are likely to default if not for meaningful sponsor or lender intervention. And that distinction is important because private credit is often a lot more flexible than public credits. Defaults can be delayed through amendments, maturity extensions, PIK toggles, or other forms of support. And what we saw in the Q1 compendium we just published is that our KMDM rate actually declined by count to 3.1x, so 3.1%, down from 3.4 the previous quarter. So the monitor is improving. By value, we are seeing larger borrowers contribute more to the stress portfolio, but the defaults continue to remain constrained. Next slide. This slide I'm not going to go too much into, but what it is we took that KMDM and we broke it down by sector. And what you would see here is that consumer retails continues to be one of the most pressured sectors. We're also seeing some stress in some labor-intensive services, in the commercial and professional services, and a little bit of the electrical equipment and construction materials. Next slide. So this slide actually addresses one of the biggest topics right now that we're currently hearing, and it's in the market right now, which is artificial intelligence risk. I'm going to spend a little longer here given all the market commentary that you've heard about AI risk and the potential impact on software and tech borrowers. What we did a deep dive at AI and software, but we didn't start with the assumption that software companies or all software companies will face the same level of risk. Instead, we actually took a look at the 495 companies we had in our portfolio that we either classified as software, information and telecommunications, or internet and data service. That is about 20% of the broader portfolio. We then developed a framework where we used to evaluate all the companies' relative exposure to AI based on the operating profile, their product offering, their business model. And the key question we're looking for was whether AI could materially affect their revenues, pricing, margins, or debt service for the next 2 to 4 years. And for the less obvious cases, we focus on a few other factors, like whether the company served as a systems of record, whether it owned proprietary data, how rules-based workflow was. Ultimately, what we were trying to do is classify these companies into 3 buckets. Would be buckets where we saw relatively high exposure to artificial intelligence risk, moderate, and relatively low. And that's what this slide is trying to encompass. And what we learned from that sort of framework analysis is actually very important. What we found out is the companies that we classified as having relatively high exposure were not actually risky simply because of AI risk. Those are some of the companies that already have some of the weakest financial profiles in that cohorts. They had the lowest median revenue growth. They had one of the highest shares of companies with declining sales. Their performance basically looked to weakening sectors than to the rest of the broader software sectors. So what does that kind of mean? We're basically seeing weakness in credit metrics among the relatively high AI exposure today relative to the total assessments. And so the conclusion we kind of take from that is that AI is not irrelevant. It's just that the companies that are most at risk from AI are already among some of the lowest assessed obligors in our portfolio. AI may become an additional pressure point, but in many cases, it's just amplifying concerns around growth, margins, liquidity, refinancing, and sponsor support that we see in those names. Next slide, please. So to recap that AI deep dive, those 41 high-risk AI company names, we looked at when their maturity were, and we basically took out the subset that had near-term maturities. These are the borrowers where you had those high AI-related uncertainty, refinancing risk, and continued weak performance. But even under a very severe hypothetical case where we took all 41 companies, we defaulted them, the impact of the KMDM will continue to be contained. So basically, the KMDM would go up to about 4.8 from 3.4 right now, which again, still is relatively low if you kind of count the default across the entire portfolio as about 5%. Again, noticeable increase, but not a broad portfolio level shock. So we don't think the scenario is very likely, but we did find out that some of the borrowers have already addressed some of their maturities, either through financing or extensions or through lender protection. And so the point I want to emphasize from this slide is that the data doesn't support the idea that all software exposure should be treated as equally vulnerable. The risks from AI are definitely real, but they are not uniform. But borrower selection, business model defensibility, sponsor support, and maturity timing matters a lot for how these companies sort of shape out over the next 2 to 4 years. Next slide. So want to just conclude all of that stuff. And basically what I'm saying is at the portfolio level, the most important mitigant that we are seeing is diversification. The 41 relatively high AI exposed borrowers with near-term maturities are spread out across more than 90 KBRA rated vehicles managed by 28 direct lenders. The median aggregate exposure per vehicle is less than 2.5, and the companies are backed by 34 unique sponsors. And that's why we believe that there's not a significant ratings migration across KBRA direct lending vehicles from AI-related stress alone. Look, our expectation continues to be our AI risk will show up in return differentiation than in broad level credit deterioration. In other words, some managers and some borrowers will enter the transition a lot better than others. The winners will be those who have stronger underwriting, better sector knowledge, more conservative structure, and the ability to distinguish between software businesses that are truly vulnerable and those that are mission critical, embedded, or protected by data, workflow, or regulatory moats. So as we sort of go back to the BDC discussion, the key takeaway that you should look at from the borrower level statistics is this: the fundamentals remain broadly stable, defaults remain contained, and AI-related risk are manageable at the portfolio level. But the dispersion is widening, and in 2026, the market is likely to reward those that have conservative leverage, strong underwriting, flexible funding, and a very, very proactive credit management. Thank you.
Wonderful. That's a great overview and really great job setting the stage for the rest of the discussion there. So yeah, Josh, maybe turning to you, digging in a little bit deeper as we talk about our BDC coverage and their AI exposure. How should we frame software exposure in our KBRA rated BDC universe in the context of AI?
Sure. Yeah. Hi, everyone, and thanks, Bing, for the question. Next slide, please. So among KBRA's 35 plus rated BDCs, the range of software exposure is broad, as you can see on the graph below. But the median is about 14% of total investments at fair value. And this was put together based on publicly reported portfolio data, while noting that the numbers should be taken as directional since not all BDCs categorize industry exposure the same way. So this 14% is below the 18% of total debt exposure in Shane's portfolio that he covered, and the often quoted 20% figure across the broader BDC universe. Even so, software exposure is meaningful in KBRA's rated BDC portfolios, but it's not the entire portfolio story. Perhaps more important, however, as Shane covered, is the quality of the software borrowers within that exposure. So one thing that's somewhat maybe different than Shane's portfolio is that in certain cases that KBRA rated BDCs some of them lend to sizable upper middle market software companies. These could have enterprise values in the billions of dollars, have long-term recurring revenue contracts with large multinational customers. And in many cases, the software is mission critical, embedded in core customer workflows, and also is protected by proprietary data or regulatory moats. And that distinction really matters because the narrative around software could sometimes be generalized. And really importantly is that we found that a lot of our rated BDC managers have a good grasp and understanding of this, of which software companies are more at risk of AI disruption than others. And in many cases, similar to what Shane's team has done, these BDCs have developed and implemented really robust, multifaceted internal frameworks that rank each software borrower by relative exposure to AI disruption. And in other cases, we've also seen some managers hire independent consultants to get an independent view and identify the AI risk within their portfolios. Also, many of their KBR rated BDCs, especially those with meaningful software exposure, are not new to the space. So they've been lending to technology and software for years. And within technology, they're accustomed to evaluating disruption risk, product durability, customer retention, and competitive positioning. So AI really just is the newest risk to the incumbent tech that they need to underwrite and monitor. Our analysis also highlighted how difficult it is to predict which businesses AI will truly disrupt. If we had the benefit of is credit memos, financials, board decks, and understanding of the sponsor relationship. Similarly, KBR rated BDCs have a deep understanding of their portfolio companies and have experience in the industry. And those are really the people who are best equipped to make the assessment and to correctly categorize a software company. Some examples that we've seen for certain sectors that might be difficult to categorize. One is in radiology. I've seen some headlines recently. So when AI first came out, everybody said radiologists are going to go away. AI can do a pretty good job over there. But we've actually seen as radiology headcount has increased. And therefore radiology software has also the demand has been strong there. So it's a good reminder that AI doesn't always displace the incumbent, but sometimes it can actually reinforce the value of the established platform. And there's several other examples of that as well. So, that's the framing point I would start with, that software exposure varies, but software exposure alone does not tell you enough. You have to look at each BDC individually and the type of software, its end market, the quality of borrower, and the strength of the sponsor. And then, of course, the lender's experience underwriting in that space.
Great. So that's really helpful background, Josh. So what would you say are the key risks for KBRA rated BDCs with software exposures? Is the bigger issue actual software defaults or software related defaults, or is there something else that we should be keeping in mind?
Yeah, great question. So for KBRA rated BDCs, the more immediate issue doesn't appear to be broad software defaults, but rather the effect that negative investor sentiment could have on spread widening, and then in turn, loan valuation marks, NAV, and then ultimately financial flexibility. So I'll break that down a bit. So given the recent negative market sentiment, software spreads have widened to both the public and private markets. Wider spreads then can result in negative marks and unrealized losses, which in turn can push leverage higher. And then pressure on earnings can reinforce that cycle. This then can erode BDC's financial flexibility as it becomes more difficult for BDCs to raise fresh capital or cause their lender banks to be more cautious and lower advance rates on their revolving credit facilities. And to be clear, KBR's current view is that these risks remain manageable for several reasons. First, as mentioned, BDC managers are well aware of the risk AI poses, and these loans are generally performing well, Shane covered, with credit performance across KBRA's rated BDC universe relatively benign. Additionally, BDC portfolios are generally well diversified, with individual exposures often limited by design to the low single digits as percentage of portfolios. For example, KBRA has observed that market-wide, some large software loans are distributed across 100 or more lending vehicles. As a result, even when the underlying loan is sizable, exposure at any one BDC is often a relatively small share of its overall portfolio. Also, we've talked to different firms and BDCs and valuation firms, and the valuation firms specifically have stated that credit fundamentals, which, as we said, are currently solid, are the primary input when valuing a company, and those credit fundamentals play a larger role in valuation than do spread moves. As a result, we don't expect spread widening to fully flow through to private market valuations or to drive a material increase in leverage on its own. In other words, the risk is more likely to manifest slowly, first through marks, leverage, and financial flexibility before it shows up as defaults.
Great. And then maybe just one more question for you, Josh. We heard a little bit ago about the broader private credit maturity wall. How are KBRA rated BDCs likely to handle software related borrowers with near-term maturities?
Sure. Yeah. Thank you. And I was happy to see Shane had a slide on that. And that's something we were discussing with our BDCs as well. So as software borrowers approach maturity, lenders are typically separating them into three buckets. The high risk, medium risk, or low risk. So first are the beneficiaries of AI that, like you mentioned earlier. So those names, should be able to refinance and may even be stronger credits. So, and this positive impact that AI can have on software companies is sometimes missing from the common narrative. Second is the middle group. So companies that may face some pressures, but they're still operational, still profitable in today's environment. And for these borrowers, the likely path is re-underwriting under current conditions. So that means refinancing or extended, but this time at wider spreads, tighter documentation, and stronger lender protections. And based on what we're hearing from BDCs, the first two outcomes should apply to the vast majority of software names. Again, this can be an attractive market for lenders because it means re-underwriting a familiar business, but in a more lender-friendly market. And importantly, another thing we've heard is that this dynamic also applies to new underwriting, so not just refinancings. So BDCs are seeing the current market for managers with expertise to lean into the space as more attractive for lenders to software companies. Again, as I said before, there's less competition, wider spreads, better docs, and at the same time, AI is making some software companies stronger and higher credit quality. And then the third bucket, the smaller group that combines meaningful AI vulnerability and also, as Shane mentioned, combined with weaker credit metrics. So those are the credits where lenders may be less willing to extend and where sponsor support becomes much more important. So BDCs have been transparent. This bucket does exist. They're not infallible, and some loans will default as expected in direct lending. Again, this is expected to be a small portion. So importantly, though, it's good to keep in mind that BDCs have a really good insight in that they keep really close tabs on their portfolio companies. And as Shane mentioned, a lot of them are working through these any problem names ahead of maturity, and many times with really strong deal sponsors. And that sponsor strength is key here. So in many cases, it still makes economic sense for sponsors who are heavily invested, sometimes into the tune of billions of dollars, to inject additional equity rather than walk away from their investment. So unsurprisingly, private credit managers have expressed concern for those private credit shops that are exposed to software and haven't been able to realize those investments than the lenders, meaning the BDCs themselves, who are structurally protected. So, in summary, the ratings takeaway is this. KBRA does not expect broad AI-driven ratings migration across our rated BDCs. Portfolio diversification, solid credit fundamentals, backed by strong sponsors, and a focus on mission-critical enterprise software to help mitigate individual AI risks. we talk often with our rated BDCs and are definitely keeping a close eye on marks and any impact that may have on liquidity and financial flexibility.
Great. Thank you, Josh. Kevin, maybe turning to you. So, and maybe on a broader scale. So, how would you characterize the overall health of the non-perpetual BDC sector to date?
Yeah, at a high level, the sector is still in a stable position, but the environment is clearly becoming more challenging at this point. The key theme we're seeing is increasing dispersion and performance across BDCs. That's similar to what Shane was saying. If you look at the median metrics, leverage around 120, non-accrual is just over 2% at cost, and NII roughly covering distributions. The sector still looks fundamentally sound, but beneath that, performance is diverging more meaningfully across BDCs. Stronger BDCs are continuing to perform well, while weaker names are starting to show pressure through higher non-accruals, NAV erosion, and weaker earnings coverage. So, in our view, the story for 2026 is less about systemic stress, although there is some of that, of course, in the macro environment, for example. The story for 2026, we think, is more about credit selection and balance sheet discipline.
Great, thanks. And then in terms of leverage for this group, what are we seeing in terms of leverage trends, and where do you see potential risk going forward?
Well, leverage with respect to KBRA rated non-perpetual BDCs remains reasonable in aggregate. As mentioned, the median is about 120, which is comfortably within that 2-to-1 regulatory limit, and it's generally aligned with management targets. That said, leverage is becoming more of a differentiator. There are a handful of BDCs operating over 130 and even around 150. And in many of those cases, higher leverage, is coinciding with weaker credit performance or softer earnings. That combination is where we see more risk. So looking ahead, we could see some modest upward pressure on leverage, particularly where NAV is declining or earnings are under pressure. But most BDCs still have the flexibility to manage within their targets. But our near-term expectation for the first quarter in particular is pressure on NAV from near-term pressure on valuations, which will flow into leverage. Beyond the first quarter, projections become a little murkier with our rated names. But again, it's not leverage in isolation. It's how leverage interacts with asset quality and earning stability.
Right. And we have seen some data points from a few of the larger BDCs out there, and some of the alternative asset managers have disclosed some preliminary stats on their BDCs. How are these shaping up, and how are we thinking about credit quality and non-accrual trends for the rest of 2026?
Yeah, speaking specifically, to Blue Owl's preliminary data, credit quality there remains strong with low non-accruals across their BDCs, generally in that 0.2 to 0.1% range, and with portfolios concentrated in first lien loans with conservative leverage. That said, early signs of normalization are emerging there, including modest mark pressure and slower net deployment, and that does suggest some softening in the operating environment. So Blue Owl's non-accruals, they may drift higher through 2026, but current levels remain low and appear manageable. For non-perpetuals overall, and I'll let Terry speak to Perpetual-Life BDCs, but for our non-perpetuals, yeah, we don't yet have first quarter data for the vast majority of names. But as of the end of the year, non-accruals were still relatively low, around that 2.3% at cost and 1.1% at fair value range across our rated non-perpetuals. But we have seen upward movement over the last year or so, and we expect first quarter earnings to show some additional softening. That's the expectation, at least. What's notable is that deterioration is not necessarily broad-based. It's been more idiosyncratic or sector-specific. We're seeing pressure in private credit generally, in areas like healthcare, consumer, and industrial, as Shane mentioned, along with some impact from higher rates and broader macro trends. At the same time, dispersion is widening. Some of our rated BDCs continue to report very strong asset quality, while others are already seeing elevated non-accruals and realized and unrealized losses. That's the same story with PIK. We've seen almost all non-perpetual BDCs have higher PIK over the last year, and it's manageable across a rated universe, but it's been more pronounced with a few names. So the takeaway is that credit performance is still manageable, but the gap between strong and weak BDCs is widening, and that's likely to be a defining feature for 2026.
Great. And then finally, Kevin, how do you view funding liquidity for non-perpetual BDCs in this current environment?
Yeah, funding remains a relative strength for the non-perpetual BDC sector. Our rated non-perpetual BDCs, they really do continue to benefit from strong relationships with banks and solid access to capital markets, which has allowed them to refinance maturities, extend and expand bank facilities, and maintain good overall liquidity. So, the typical funding mix is also fairly balanced with about half of debt unsecured, which provides good flexibility and preserves unencumbered assets. That said, there are some important dynamics to watch. Funding structure matters more now than during more benign credit environments. Platforms with higher unsecured debt and strong liquidity have more flexibility, while those more reliant on unsecured funding and less robust liquidity profiles have less room to maneuver if credit conditions weaken. And generally, we see sector funding diversity as a credit strength, though it does vary between BDCs. We prefer to see multiple secured bank lines and secured debt across secured debt sources. And we also prefer to see well-laddered maturities of unsecured debt, and we typically see that among our non-perpetual BDCs. And often the more unsecured debt, the better from a credit perspective. So, we expect BDCs with more funding diversity to weather this less benign credit environment the best.
Great. Wonderful. Thanks, Kevin. And Terry, maybe flipping now over to the topic of perpetual BDCs, which are structured a bit differently than non-perpetual BDCs and have certainly been in the news quite a bit. So can you talk a little bit about how we analyze these structures and maybe talk a little bit about like if our methodology is different for perpetual-life BDCs versus non-perpetual BDCs?
Sure. Thanks, Spain. Yeah, there's been a lot of headline about the perpetual life BDCs over the last several months. So we wanted to try to really look at what are the key factors on a credit side, because the equity, from an equity perspective, is very different than from the debt. So when we look at perpetual life BDCs, the one thing that really stands out is the redemption feature. So while our methodology is the same credit metrics that we look at, we do take a deeper dive into liquidity management. So how these BDCs plan to provide for liquidity. I will say that under the operations, they are not required to redeem any shares. So if there was a very disruptive market and they did not have the liquidity, they do not have to. They can gate it. But they plan to issue, and this is what is presented at 5%. So when we look at a BDC, we talk to them about how are they going to provide. So they have a lot of insights into the inflows, the cash repayments, loan repayments, bank line availability, and more liquid assets, level 2. So that goes into our analysis. And the other thing that we look at is the investor diversification, because there has been issues where one pocket, whether it be overseas investors, a geographic or a type of investor that wants to redeem all at the same time. But as I've mentioned before, they are not required. So basically, we want to preserve liquidity and protect the assets valuations for both the existing shareholders and then after redemptions.
Great. So maybe to that end, how do you view the current environment for perpetual-life BDCs in terms of capital raising and redemptions?
Yeah, so for capital raising, it has slowed. Obviously, there's been a lot of, discussions that stem from, some of the actually non-BDC loans that defaulted last year, Tricolor and one of the others. So there's been, a lot of hesitancy on the retail investor to invest in BDCs. So we definitely have seen a slowdown in the capital raising, which we don't view all that bad. There was a tremendous amount of capital raised in 2025. So spreads were super tight and maybe documents weren't as stringent as they could be. So with slower capital raising and increased redemptions, maybe a better supply demand balance in transactions.
Great. That's great color, Terry. And Kevin spoke a little bit about how we look at funding liquidity for non-perpetual BDCs, but what does liquidity look like for perpetual BDCs? And can you walk a little bit through how we've done stress testing on the sector? And maybe we can go to that slide.
Sure. So we did like our own analysis. So, especially like last year, in the fourth quarter, where many of the BDCs had, met redemptions at request, which were much higher than 5%. And so there was a lot of headlines of the risk involved. But the way we were looking at them is one, the perpetual life BDCs came into the quarter with very low leverage. Transaction volume had been so low. They had a lot of cash. They had a lot of bank line liquidity. So didn't necessarily see that as negative. We did see in the first quarter that they did cap the redemptions at 5%. And that's to preserve liquidity in case this continues, this environment. So we wanted to look at what would happen and how much liquidity did the perpetual life BDCs have to be able to cover 4 quarters of 5% redemptions. So with that liquidity, we looked at the committed debt, the availability less the outstanding debt, and the unrestricted cash, and then the BSLs or the level 2 assets. And we looked at that in relation to 1 year debt maturities, 50% of the unfunded commitments, and then, like I said, 5% redemptions for 4 quarters. And we found that coverage was close to 2 times. So plenty of liquidity there. And that really stems from the low leverage too that these BDCs have, these perpetual life BDCs, they're under 1 times. So really good liquidity coverage. And then we did a leverage test to say what would happen if they have to fund these 4 quarters of redemptions and the 50%, unfunded commitments along with 1 year debt maturities. And what would that look like? And then we adjusted the equity that was outflow for those 4 quarters, and leverage was still only 1.4 times, which is well within the regulatory, which is 2 times, right? So, and that all stems from the low leverage. One thing that investors or creditors for the BDC should really look at is that the perpetual life BDCs have very low leverage. Over 90% of their assets are in first lien senior secured, so very high credit quality. And because these vehicles have mostly organized within the last 3 years, have very low non-accrual rates. The non-accrual investments are less than 0.5% of the total investment portfolio at this point. And they underwrote the loans mostly within the last 2 years while we were in a much higher interest rate environment. So should, test going forward this should be a very good vintage for these BDCs. So overall, we view the credit quality really high, leverage is low, plenty of liquidity, even to meet 5% with low inflows. Flows have not completely stopped, but we have not used them in our analysis. So we view the perpetual life BDCs in good shape.
Excellent. And then maybe one more for you, Terry. And you talked a little bit about the kind of where they sit from a lending perspective, primarily first lien credits. But how would you characterize the credit metrics of our rated universes, perpetual life BDCs? How would you characterize the credit quality at this
Yeah,
point?
I believe that they're solid, for the reasons that we've been talking about is the high first lien senior secured, very low leverage, access to the capital markets and the bank markets. So they have strong liquidity lines available. So as perpetual life BDCs raise equity, they also increase their bank lines, and they're usually a couple years ahead. So making sure that they have those liquidity lines in place. I would say our BDCs, both the perpetuals and the non-perpetuals, are part of larger asset managers who have very strong bank relationships. So we really look to that as well. The BDCs are sometimes just a very small part of an overall advisor's AUM, and are willing, the relationships with these banks are really strong.
Right. So I think that's it in terms of what we had for kind of prepared questions. But we did get a couple questions from the audience that I'd like to go through. So maybe Shane, going back to you. The question is, do we have any views on the loss severity for the names at risk? So, if we think about kind of the cohort of middle market borrowers that you were talking about, can you talk a little bit about loss severity expectations at default?
Yeah, thanks, Ben. That's actually a very good question. We are a bit cautious about making broad statements on loss severity because that at-risk population is not homogeneous. Even within the relatively high AI exposure cohorts, recovery would likely vary meaningfully based on the actual company's specific business model, the collateral package that it has, any recurring revenue durability, the lender's position, sponsor behavior before the stress, or any issues with any temporary gap, or is it a more permanent impairment to enterprise value? That said, our current view is that the AI-related stress is likely to create idiosyncratic loss outcomes than a more uniform increase of loss severity across the portfolio. The companies that we think are most at risk of those AI-related disruptions already tend to have weaker profiles today, lower growth, more pressure on cash flow conversions, and in some cases, near-term maturities. And we do believe that those loss severities could be on the higher side. For other names, though, where we can see some impact, especially today where the borrower still has a high retention, mission critical software, all those items that I mentioned that puts it at the very low end of disruption, we expect those loss severities could be a bit more manageable, even if there is a pressure on its growth or on its business model. And in those situations, again, where we think business model is more exposed to substitutions, loss severity could be a lot higher because enterprise value supports may be a lot weaker. So in short, to answer the question all over again and in full circle, we think loss severity could be higher for the weakest individual names, especially where AI risk overlaps with refinancing risk and sponsor fatigue. But we do expect that impact to be more borrower specific rather than portfolio wide.
Great. Thanks, Shane. And related to that, Terry, the other question that we got was just around, we have seen over the last year or so, valuation marks within BDC portfolios, in some instances change rather quickly from quarter to quarter. So, I know like Josh spoke a little bit about how we've talked to valuation firms, whatnot, but can you talk a little bit about how we view these changes in valuation marks from quarter to quarter? If they do change rather quickly, what typically is driving that, and then how that kind of fits into our analysis or our view of an issuer's rating.
Right, sure. As Josh had mentioned before, we do talk to the independent valuation firms, and they're really focused more on the credit quality of the portfolio company rather than market sentiment. So you do see a pretty wide difference between the public markets and the private markets. So we don't expect the valuation marks to vary that widely, as we had seen, over the course of the last quarter, based on, public sentiment. That said, we do expect that if there is a deterioration in the credit, that there will be marks. There were spreads on software, but not to the extreme that we would see in the public markets. And we feel that the leverage at the BDCs coming into the quarter is low enough to absorb that. Same with perhaps higher non-accruals. We still feel like we're in this benign environment, but that there are the risk is increasing. But because the leverage is so low, the balance sheet is quite strong. We don't see it necessarily affecting the overall credit metrics. But good question. It is something that we keep our eye on, and we are looking at the unrealized losses. But we do feel that at the end of the day, if those portfolio companies are going to repay their loans in full, that should revert back to par.
Great. And then finally, one more question for the panel. Actually, I'll direct this one to Josh. So you talked a little bit about and even Shane talked a little bit about this, the kind of the ranking or the bucketing of AI risk. Can you provide some additional color around that practice? Kind of high, medium, and low, and what we think categorization mean for defaults over time.
Yeah, sure. Thanks, Ben, for that question. Yes, that was a question I had for BDCs. Some came out saying, 5% is considered high risk for AI disruption, and that doesn't mean 5% defaults. It doesn't mean that. So what they explained is that certain businesses or firms need to keep their foot on the pedal more than others. So essentially, what example we've looked at also is tax software. So that could be displaced to a certain extent by AI if it's a workflow that's repetitive. But if incumbents can keep innovating, adding AI features, we don't think that would necessarily result in a default. So 5% that let's say 5% or other number of a high risk doesn't mean high risk of default. It just means that AI. These companies have to keep up with AI very closely, while other incumbents may have regulatory features or something else that they're a little bit more immune to that. Doesn't mean they don't have to innovate as well, but they're a bit more immune. So it definitely doesn't mean that they're high risk that they're of default, but high risk to disruption, and so they have to keep up. So
Wonderful. Well, I don't see any other questions in the queue, but very much thank you for participating today. To those that dialed in, to our panelists, thank you so much for giving a really great color, not only kind of the broader private credit world, but then also how we're thinking about the BDCs. Thanks everybody for joining. To find more information, you can see on private credit, BDCs, and our rest of our coverage on KBRA.com. And have a wonderful day. Thank you.